Good morning, everybody, and a very warm welcome to this fourth chapter in our Level Up Your Customer Journey webinars series. My name is Jacob Fergeman, and I'm here with me. I have Bartek Staszewski. I'm sitting in Copenhagen, and Bartek is sitting live from our Warsaw office. And today we're going to talk a little bit about your collection management activities. The collection activities is something that is getting very high attention right now with our clients, not only in Nordics, Europe, but everywhere we have conversations with clients. Collection is an area where there's much more attention in terms of digitizing and be much more effective, both internally, but certainly also externally. But before we crack on with the session itself, just a bit of housekeeping in terms of the platform you have now entered. As you can see on the right side, there's a chat box and Q&A box where you are able to ask questions or comments if you have any. I really encourage you to post your questions or comments if you have any, and we are very pleased to address them during the call. Also, what you can see on the screen is there's a Zoom function in case the screen is not big enough for to be able to follow what's on the screen. Please zoom in, and that tool is quite useful in terms of being able to understand what is available on the screen. Right, but during today on the agenda, we have a few points to go through. The first point is around risk insights, where we're going to take a step back to look into what we have seen during the financial crisis, but also what we have experienced so far during COVID-19. Then we'll go into the prevention measures that we see work best in the current setup with early warning, but also early collection and collection activities. I mentioned digital before, and now we're seeing players moving into a much more digital activity with their customers, but also internally in order to optimize processes. Finally, we'll put a little bit of product placement on how experience support collection management with our clients across EMEA. And then in the very end, we will give you the opportunity to address questions that we will answer accordingly. But let's move on to look into the financial crisis that we saw during the 2008, 2009, 2010. From a personal reflection, I started as a credit risk manager in December 2008, and we quickly identified that something was very wrong in terms of the quality of our customers. We saw the losses increase significantly and very, very fast. Customers we thought had a very good credit profile didn't have a very good credit profile. And what did that mean? It meant that very quickly, and illustrated with this slide, within 3 months, we could see a high peak in delinquencies after the first blow to the economy. This is illustrated with the Lehman Brothers and the peak in delinquencies on credit card delinquencies across all commercial banks. But the picture remains. We saw a very, very quick and rapid increase in delinquencies and stressed customers. When we move forward fast to 2020, March, April, we saw COVID-19 come into play, and we had a high expectation for an increase in delinquencies and more stressed customers. And I will give the word now to Bartek to put on a few reflections on what we saw during COVID-19 and are still observing.
Yeah. So, hello everyone. So the reflections is the following. It seems like everyone gets a little bit hysterical about what's going to happen, and literally it didn't happen, or it didn't happen that severely as anyone expected. Now it's quite difficult to say why it is like this. Is it the governmental help, or is it the aid programs, or is it the rebuild program or governmental support, or the customers were good enough, so our originations and our risk policies were good enough? It's hard to say. I can give you the example of what happened to myself when I was on the project with the customers abroad. Outside of Poland. It was the March 2020, so just before the lockdowns. I called my bank and I asked them to give me a very small credit card increase. And since I'm self-employed, that's just because of working type, I was refused. And I was refused because the collections manager said, to the risk managers who said to everyone that no uplift, no upsell for sole traders. Imagine, believe it or not, 3 months later they called me with pre-approved offer for extremely high unsecured loan because they decided that I'm a good client. And the question is, was it a good or bad decision that they rejected me? So from the sales point of view, it was a terrible decision because I could change the bank. In fact, I'm too lazy to change the bank. I have too many products and too many relationships and too long relationship to do that. From the risk point of view, it was a good decision because on the portfolio measures, it was the right decision because they prevented the risk. What hits me the most was that despite the fact that my bank claimed to be AI ready and fully equipped with machine learning models and so on, at the end of the day, the critical decision was taken based on single man, the head of collections, decision not to support this client, not to increase the limits to this client. From my point of view, as an ex-risk manager, yes, it was a right decision, this industry blocker. And coming back to the global picture, what really happened, it wasn't the global disaster. It wasn't the whole economy disaster. What happened, we have the punctual, some specific industries problems like restaurants, like any that was connected with the transportation. So, for instance, any industries that need a supply from China because the global chain of transportation was collapsed for a moment. But other industries like, especially connected with online, like e-trade or food delivery by the couriers, grew up. And I see many clients that did a good business on that. I will not read the slide. You can see it yourself. But the point is that different from the market to market, different from different economies, and depend on the behavior of government, we were expecting to see much more losses than we really noticed. And investments in collections and investments in modern and digital tools seems to be adequate to what happened because there is no losses. We will show you the examples of how our clients went through the crisis time and what are they doing right now. And let's go to the next slide, please. So these are quotes from our clients. What were the expectations? Like I said, everyone expected two things. One, that the impact of the COVID will be terrible or at least severe, which fortunately didn't realize in most of our clients' P&Ls. And secondly, and this is 100% realized, move to digital. All of our clients, from this way or another, using different tools, using automation, using chatbots, using automated online or automated phone calls or chatbots or robotics. They just moved into the collections world and they try to move their clients into the collections world. I have the examples of the customers that were very much in the branch level, into branch model, and they have clients, mostly seniors or adults, that are somehow digitally excluded. They are not used to use mobile phones. They are not used to work on digital. They are retired people. So in fact, it was the biggest challenge for them, how to make the seniors, how to make the old ones use mobile and use digital channel. But what we expect, what we observe with our customers is that digital channel is the most important one, and the digital service, the customer journey, the customer expectations are very high. So yes, the usage increased, but the expectations and demand from the customers, how it should be done, also increased. Let's go to the next slide, please. The impact of global pandemic from economy to economy. Herman was supposed to comment on the Netherlands. What I can tell you, what I know from Herman is that despite the fact that COVID impact was the economic growth in 2021 is really impressive, because in economy like Netherlands, 3.7% is extremely high number from my point of view. There is a low unemployment rates, and as a warning signal is the energy prices, which are going up very rapidly, even by 200 or even more percent. And this is a high risk for consumers and also for the industry. And let's go to the next slide. I will show you the impact of Polish economy. So there was a very low number of bankruptcies, except some limited industries. The unemployment is very low, and unexpectedly, we have best ever results in the mortgage market. Prices of real estate goes up like crazy. There is a very high inflation rate. I think the highest from the last 30 years. It's on the slide is 5%. Now it's 6%. Yesterday I read the notes, and there is very limited reaction on the national bank side, which is really worrying. Like in Netherlands, the Polish economy suffers from very high prices of energy, and it's going to hit the private individuals in December, and it's going to hit the industry right now. It's happening. The government reported 11.1% GDP growth quarter to quarter, 2020, 2021, and this is not a mistake. It's really double digit. However, it depends on the measure. It depends on the calculations. I've seen the same period measured by Deloitte, which shows something more close to 4%, which is more realistic. And the reason why I'm showing this is that I observed that there is a lot of, I would say, PR around the pandemic, and there is a lot of PR around the actions that were taken versus pandemic. So what I see is that there is a little bit election game and a voting game around the pandemic and the support parameters and so on. But the outlook is looking good. However, there is a risk of high inflation. Poland is not in Eurozone, so it's not dangerous for Europe, but it is connected to the Europe. So somehow it may be worrisome signal. Over to you, Jacob, for Denmark.
Thanks a lot, Bartek, and interesting perspective on the PR point of view, because certainly I think if we look into the Danish context, we have seen very generous support packages for businesses, but also consumers or private individuals have been also given significant liquidity relief to the economy. And this has really sparked the consumption, as you've also seen in other markets, as you mentioned. These packages have for sure meant that the level of bankruptcies have been kept at a low level. Also, unemployment figures, and I've by purpose put yet in italics here. I'll come back to that. What we've seen is that spending patterns changed quite significantly during Corona, but people still wanted to spend the money they had. So they changed the way they spent the money. And we saw that people suddenly interested in renovating the house or buying a bigger house or a summer house, which has meant a significant increase in the house prices across Denmark, where the prices were already at a very high level. And last week, the National Bank gave a warning to the government that they should take some considerations in terms of controlling the development of the housing market. So the question really remains, who is going to pay for it? Is it going to be our generation, our tax base, or are we going to move the cost or the bill to the future generations? And to your point, Bartek, election time is coming up, and I'm interested to see who the politicians will point to in terms of who's going to pay for the cost of this. And also just one quick remark regarding the companies. There is a big price to pay in March when 2 years of delayed VAT payments is going to happen. And it'll be interesting to see what the ability is to put that liquidity back to the tax system, or they can be transferred as a Corona loan with the banks. Time will tell. But then, what are the focus areas as you mentioned before, Bartek? What we see now is that prevention is better than cure. Early warning is certainly something banks are looking into. And we also see it from a regulatory pressure in terms of managing and controlling the risk profiling of customers, much more active than we have seen in the past. Understanding the behaviors of customers is also something banks are now starting to explore more and more, really to see what is the digital footprint, what are the type of transactions being performed, understanding is the liquidity going to be pressured, or what are the elements we're going to see for customers moving forward. Certainly, the stress indicators are something that needs to be explored further for banks and other type of organizations to be sure that they manage customers as fast and as early as possible. This means that we need the KPIs. We need probably to calibrate or create new type of KPIs, because now we're working in a more digital environment with a much more focus on customers. So maybe it's different type of KPIs we need to monitor clients on in terms of being able to relieve the stress as fast as possible. And last but not least, digital. We do see digitalization is coming in. This has been the word for the last 20, 25 years, but we'll come up with some examples later on in the presentation on what does it actually look like in real life with some of the clients we're working with. I will now give the word back to you, Bartek, in terms of talking about prevention.
Yes, so what I would like to do now, I would like to share with you a story. This is not a story of a single client. This is, I would say, general concept, a general observation from the markets, from how our clients acted, and I will show you how it was moved from the concept, from the vision to execution. Let's go to the next slide, please. So the whole story. Can we click the next slide, please? So the whole story begin. The slide. Thank you. So the whole story begin with the vision. The visions come from the organization. Different clients have the different organization type. Sometimes collections is a part of risk department, and it's 100% focused on prevention of losses, on provisions, or the stop loss activities. Sometimes collections is part of operations, which actually leads to the same KPI, but in a different way. So they are focused on productivity, on operational work, on automation, and so on. And sometimes it's divided. So I've seen the organization that has, for instance, early collections in operations and late collections and recovery in risk. Depending on the model, the vision is a little bit different, and it turns from point to point. However, this is the overall concept, and how it goes. This vision should start in some place. Very often, it's driven by the regulations. The local regulations, in fact, decide whether the collections can be done cloud or hosted, or must be done on premise. Sometimes, of course, it's a group decision to keep it on premise, as this is quite a heavy software and a heavy process, and wants to keep it inside. Also, the personal data and the GDPR implementation in a given country sometimes lead to the certain solutions. On top of that, there is analytics and implementation of strategies and the models. Again, this is combination of regulations of the operational framework and IT framework. Our clients somehow decided that the most important outcome will be the consumer engagement and analytics connected with BI, and they started to lead and to navigate their organizations into this direction. We can move to the next slide, please. Okay, so what we've seen, what our clients did, they started to build new models. Yes, our clients are using machine learning. There are some countries where this is not allowed, sometimes where this is because of the explanatory and auditability of the models. Regulators don't want to see the black box. They want to see everything explained. They want to see models explained to the customers. So sometimes it's quite impossible to use it. However, there is a plenty of data around, and there is a plenty of new data. And the more customer gets digital, And the more you move your customers to the digital, the more information you get. You get device fingerprint, you get location data, you get open banking information with all that comes from it. You get also a lot of information from the fraud systems. You get information from banking, insurance, or telco history. And there's a plenty of outside data. There is credit bureau, obviously, but there are external databases, and there's plenty of services that customers use outside. There is I would say, wave and storm of the data. There is a very lot of information that needs to be aggregated. Machine learning models works the best, use the best, but the traditional models will do as well. What our clients decided to do, they wanted to build a strategy. They wanted to build the profiles of a single customer, the single customer view, and to focus on customer journey and customer, I would say, customer experience, which in collections is easier to say than done. Let's go to the next slide, please. So the outcome of it was even better customer journey, even better customer experience, resulted in a better segmentation and better understanding of customer expectations, preferred channel, preferred time of contact, and the risk behind the customer. Like I said, it's easier to say than done, and it may seem to be a quite ridiculous to try to engage the customers in collections and try to work on the customer journey in collections. But in a mature markets where customers are already sold and every customer has a financial service or telco service or insurance service, seems like you need to compete on every possible way. And the customer journey in a times when up to 20% on the monthly basis enters the collections in given financial industries, and even in the tier one banks, it can be 5 to 6% collections entry because of many dimensions and not always customer problems. It seems to be very efficient. This is kind of prevention. This allows to define and find out the financial problems or potential problems of payments from the customer point of view even before it appears. The IFRS 9 gave the financial institutions a little bit less time than previously to handle financial problems or financial delay of the customer. And it seems that despite the fact that collection strategies were enhanced, 30 days from the first delinquency to 30 DPD seems to be a little bit too low to cure all the customers. That's why pre-collections and pre-collections score and pre-collections understanding of clients seems to be so important. Let's go to the next slide. What our clients built at the end of the day is something we can call early warning system. This has many names and many dimensions. What it is kind of environment, environment is a good word, of models and maybe warning signals that helps you to identify customers before they get into financial difficulties and late payments, and to enhance the better strategy and the better treatment to the customers when they are there. You have many customers from many profiles and many segments, and of course, many organizations are working to find out the new segmentations for sales and for customer management. What our clients want to do, and we are helping with, is to build a profile of one, meaning that every client may have kind of an individual treatment and kind of individual path. Of course, they are still member of a bigger segments, but it can be defined and personalized to let at least customer think that bank or financial institution designed individual treatment for them. Early warning is an ecosystem of models and infrastructure and data management that allows you to identify any potential risk quicker and to apply the better treatment and the most optimal treatment and strategy towards the customers. And of course, from early warning, we can go to the next slide. You need the tool that allows you to manage it, some kind of decision engine. This is an example of how the strategy design can look like, and this is the pure execution of what I just said before. So coming from the unstructured data through the structurization of data and advanced models, going to individual treatment and going to the best customer experience through the execution of strategy design. This was the path that our customers did for the last 2 years during the pandemic. And I wouldn't be fair if I say that the job is done. There is still a lot of things to do, but this is the general direction that everybody that is making a success on a collections market is moving. Over to you.
Thanks, Bartek. And just to echo what you said previously regarding the complexity of what is a customer. Last week, we had our customer management series where we discussed what is a customer. Do we define it at facility level, i.e. product level, customer level, or household level? That type of complexity is very important to navigate within in order to understand which data to capture, hence also what type of strategies to implement. And that is a good curveball to the next session where we are talking about going digital. Because when we talk digital, obviously we need data to be able to address what type of activities or actions should we suggest for our customers or our stressed customers. What we do see is that the client web portal applications on a phone is something that is much more visible now. What I've seen so far in my local market is that the local DCAs have created apps where you can manage your account or your collection account proactively without having to access underwriter or a clerk with a DCA. So you can actually set up the payment plan accordingly in a very, very digital way, either throughout customer communications with an individual, or there's a virtual assistant, or there's a self-service portal. All this optimize the resources available and can enable a better customer experience. Those who prefer to speak with a computer or a virtual assistant, they can do accordingly. And those who need more help from a customer advisor, then that is also an option. But it's not necessarily 100% that needs to go to a customer team. We have different platforms. Of course, those who are really struggling with stressed economy, they go to the hardship workflow. Those who have temporary stress symptoms, they go to the COVID-19 assist option. We saw that very clearly last year, both in managing companies, but also private individuals. They should go to individuals at banks or other type of organizations who are specialized in managing temporary stress symptoms on how to relieve the financial economy for a temporary period. And that also needs to be put into different options on the right side of the screen. As you can see, I will not read it out, but I will just mention the very bottom line, which mentions cloud enabled. And I think cloud is really something that many organizations have been hesitant to move towards. But now with a much more focus on lean and minimizing IT cost, we do see that cloud-enabled solutions is something organizations are moving towards in order to gear themselves for the future. So when we talk about digitalization of collections, what it means is that there should be an access, a platform for customers to manage the individual account, as I mentioned before. We should be able to set up a budget online in one way or the other. And based on the output from this budget, we should be able to make a payment plan that fits well with my current economy, but also having respect for the financial obligation I have as a customer. And then I should be able to make a direct payment, illustrated with Visa and MasterCard in this particular example. And what is also relevant is that the customer experience is thought through. I've spoken with clients where we see on this screen we have 6 different, very, very clear direction for a client in order to get to the very end and make a full payment. If just one of these links is missing and is not well connected to the workflow and also the strategy design environment, then it can be a quite tricky situation, not only for the customer, but certainly also for the collection department to manage the customers effectively. So the front end illustrated in this example needs to be very well tied into the workflow system and also the strategies in order to use the data available as relevant, concrete, and effective as possible. And what we've seen here is a short summary of what has worked with some of our clients. 24/7 service is clearly a benefit for going online, especially if you have a virtual assistant who can do a lot of the more trivial support that does not need an individual to manage. Then that is a very helpful tool to optimize collection activities. As Bartek also mentioned, use data within analytics to be able to discriminate and rank order customers according to payment likelihood and ability to pay over time is also clearly a support in terms of making most use of the resources available. And this will lead to a reduction in outgoing calls, because those who really cannot pay and there's no willingness to pay don't do massive amount of manual work, do that to more specialists in that area. And working with digital, we need to make sure that data is clean, it's accurate, and it's fit for purpose. And the day that we have happy customers, even though they are in stress, then we have the ability to build up a loyalty program where we can even make sure that the customers do not churn, even though they are probably in a very difficult position right now with your bank. I often like this statement from a Nordic organization where I walk through the collection department, and on the screensaver, there was a reminder to the people working in the customer service center. And it was that, and there was a picture of a bonsai tree. And the message was, remember, customers are like a bonsai tree, treat it well, and you'll have them forever. And I think that's a very, very important statement to have in all client dialogue, even though customers may be in a stressful situation occasionally. So what is a virtual assistant in collections? What it is that we have this screen on the left side where it's able to communicate with the customer 24/7. Of course, what is important is that the virtual assistant is learning by experience. So there needs to be a machine learning component that learns from experience to make sure that we don't see any, let's say, wrong comments based on input from the customer. That is something we see more and more applicable, in particular in the DCA environment, but also more and more within the bank environment. I have also seen cases where the virtual assistant still needs some training in order to be completely effective, but it's learning by doing, and we need to build on experience. Now I will leave the word over to you, Bartek, to take us through what is it then where we can help as an organization.
Thank you, Jakob. I love your story about bonsai, being honest. It makes me thinking about my Harriswood fern, the fern I bought recently, and I was given a very precise instruction what to do. So half a glass of warm water, and once a week a cup of green tea for the fern. I put it on the window when there is no sun, as expected. It's dying. I have no idea why, because I did everything right, but my plant, my customer, is leaving me. I need to get some more data, I guess, and understand how. Let's go to the next slide, please. As Experian, the focus areas. prevention, like we described. This is what we are focusing right now, and we are working with many customers how to do that. The behavioral insights to understand the risk, understand the customer, and help to grow exposure. Recalibration of KPI, and of course digitalization. This is our focus areas too, and this is the space in which we can help. And how? Let's go to the next slide, and I will walk you through that. So what we are best at is the, gathered on this slide. Of course, in many countries we have the bureau data, and we can help with the bureau data, but also what we can do, we can help you to integrate the external data from the credit bureau in the countries when we are not having credit bureau, and help you to understand and interpret the information that comes through it. Early warning systems, we said about it before. We have the proven track record of building it with our customers. We have also experience from customers that built it on their own, and we can share what went well, what went wrong, and which pitfalls needs to be avoided. Web data insights, this is our service in which we capture the most accurate and the most up-to-date information that can be found on Google, which is very good to be used as an additional input or a warning signal or a model input, especially for sole traders, SMEs, and other companies. Just to give you the glimpse of what it does, it captures the up-to-date information and the current events that happens to your clients all across the world. So if there is any complaints in Google, or any discussion about the customer on some forum, or there is some unexpected event around the customers, you can see this information and you can react much faster than on the regular monitoring, when you collect mostly the financial statements and general information about the board of the company and so on. Collection software, this is, I think, what you know us the best from our PowerCurve platform, PowerCurve Collections, previously Tallyman. This is a well-known software with its pluses and deltas, of course, but it's still being developed, and Experian is still adding the new features to that. It's quite well known in the industry. If you are interested, we are happy to discuss. Digital customer assist platform, including chatbot, like Jakob described it. This is quite fashion, but also industry standards at the moment. I think most of the companies is using either chatbot or voice bot or any of that. From my personal experience, this is quite difficult to convince customers to talk to the chatbot. So there are many visions and ideas how to do it. Sometimes it only plays the message to the customers. There is no interaction. Sometimes customers interact by pressing the buttons on the screen of the phone or tablet. Sometimes customers talks to the robot, and the robot is able to understand and transfer the voice to text, and then there is analytics behind, and there is again text to voice and messages replied to the customers. If this is done pretty fast, it's there, it's working, but sometimes customers don't want to talk to this. My observation is that surprisingly, the older clients like to talk to the chatbot, and the younger one not necessarily. They prefer digital channel, but that's not a rule. And of course, customers behave differently from country to country and from generation to generation. Analytical support, this is our expertise, I can say. We know the data, and we are on top of the data insights. We build the models for our customers. Standard one, regulatory models approved by the regulators, but of course, we have our data scientist lab and our data lab. We're trying to invent the new features. We are working heavily on machine learning model testing new methodologies, and testing how these models can be implemented, what is the value of them, what is the stability in time. Experian did a great effort, and Experian did a lot of investment to make sure that our machine learning models are explainable. So from our point of view, they are ready to discuss with regulatory the implementation and the usage of those models in even IRB stated banks. But of course, this is a long discussion and it differs from country to country. And last but not least is macroeconomic data. Again, Experian invests a lot in macroeconomic office, and we gather the information from countries to countries and from the regions, and we can transfer them into IFRS 9 wise information that can be used for the model feedback. Of course, we also build the macroeconomic models for the regulatory purposes. We have our huge data scientist hub located in Sofia, Bulgaria. There is an international, I would say, set of people working there. I wouldn't say that we have unlimited resources, but we can supply our clients both with models, but also with the modelers if needed, or the validators. So if our customers have any problems with the resources, we simply can outsource people or even the teams, like the manager and the team that is doing a special task, and the customer is only supervising them. This is what we do. This is how we help our clients. If you are interested, then we encourage you to contact us. And I think now we can try to move to Q&A session and close our webinar.
Excellent. Thank you, Bartek, for this update and very interesting insights from your market and from your previous work experience working as head of collection at a bank in your market. Now it's time to Q&A, and we have a question from the audience. Let me just find the question. Having in mind that banks may define customers differently, being on facility, product level, customer level, or household level, what is your take on that, Bartek? And I can also chip in afterwards in terms of what does that then mean for setting a collection strategy accordingly?
This is a very interesting question. Thank you for that, because I forgot to say something about it. And there is no easy answer, of course. And this is something I had always the biggest problem with, whether I was acting as a head of collections or a head of risk. The segmentation that touches each other. So you have household and you have private individual, but the same is, for instance, when you have a private individual like me. I have a private account in a bank, but also I have self-employed account. Which means that I can be treated by a bank as a two, even though I'm one person and I have one financials. As an extreme, what I've seen that banks were unable to distinguish between those groups, and they were, I would say, treating customers twice. So in this case, I would receive two phone calls, one as an individual, one as sole trader, or I would receive one phone call as me, Bartek, and the second as a household. For instance, if I have private loan, like installment loan, and a mortgage I have with my wife, and the private loan I have private, then I would receive two phone calls. So the answer is as following. First, the data hierarchization and the data hierarchy, leading and building the behavioral scores for the customers and building the treatment on account level, and integrating all the information about the customer, which means that when you build a profile and when you build a collection strategy, you need to make sure that you capture all the information. And then, of course, you can have a conflict. Conflict meaning here is the mortgage and household, and here is the credit card, and you have to call both. So the first answer will be, let's try to solve it with one call and one contact, and let's discuss the customer account. The second is, here I have one customer, here I have two customers, and I can call two if one will not answer. And for this, there is no easy answer. For this, I would say, and I would encourage my clients to test what works better. Some clients try to identify who is the main borrower. Main borrower means who is the owner of the assets or who is the main income bringer. But let's say it's 50-50. I make with my wife 50-50. Then who would you call? Alphabetic order, or the gender, or I don't know, the age? It really depends, and it differs from market to market which works better. I would encourage in this case to use a champion challenger and run the test. And run the test, I think, on the segment level. So I would treat it differently, mass market, and treat different affluent. But I think this type of concept would be behind it. So who is the owner of asset? Who is the main income bringer. But again, for instance, in my case, it will be much easier to reach my wife than me in a given hours, in a collections working hours, as she works typically afternoon. Both of us can answer, both of us can make a PTP. The question is, what happens if you call both and both makes a PTP? And then how you appreciate your collections worker or collections robot for doing that. But I think that characterization of the data will be the first that will lead you to the building the profile of a customer. Then it's up to organization to decide which takes the priority. And definitely, it should be solved by one call, because nothing annoys customers than free collections calls during the one day. That would be from me. Over to you, Jakob.
Yeah, thanks, Bartek. And just to put a little bit even more flavor to your response, Bartek, and feel free to join afterwards. We did a project with a big bank in Central Europe earlier this year, and that was both early warning strategies, but also early collection strategies, all the way to 120 days past due. And one of the interesting elements now coming in is, how do we manage the new definition of default in collection space? Because that also needs to be taken into account, because that impacts the provision activities more than it did before. So those who are not familiar with the new definition of default, now we do a count in terms of number of days in collection, not necessarily how many days past due they are with the delayed payments. And that impacts also those who are in bucket one, those type of customers. And to your point, Bartik, with your example with you and your wife, with promise to pay from both of you, what does it then mean for the data capture afterwards? Is very interesting to monitor going forward, because right now we need to make assumptions on our strategy on a new, completely new definition of default that needs to be integrated into the decision strategies, but also in the workflow system, in order to capture this information accurately. And if we talk about SMEs, this also means, I know you are a sole trader, Bartek, but if you're suddenly a sole trader with a collateral, you have an office building somewhere, that also needs to be understood if that value is still accurate, in terms of being sure that the security is accurate based on the information available, putting a whole new dimension into the collection strategies, but certainly also the early warning systems. And having said that, Bartik, I have a question now on early warning strategies, in terms of, now we have been talking a little bit about theory. It looks very good on digital, on PowerPoints, but real life early warning systems that work well. Do you perhaps have any real life examples you can share with us?
Yes. Thank you for this question. I think I can give at least two very good examples, again from CE region. And they are both from international banking groups, well known and well established, with a very good reputation. It's a tier one bank. So one did the implementation with the focus of prevention, and I think the end result was really fantastic, because I think the inflow from bucket 0 to bucket 1 was decreased by 20%. And this is quite large bank, so this was a substantial number. I cannot share the name of the client, but this was quite successful outcome. However, quite painful implementation, because it was time consuming. And the other implementation I have in my mind is it's the project that you mentioned. Yes, it's also there was also implementation of the whole system. Here, the focus went on provision and implementation of the definition of default and prevent losses. So it was not that important to focus on the number of customers going into from bucket 0 to bucket 1 and rolling, but rather the volume behind. So the focus here was on the high tickets, on the high ticket products like mortgages. So it was a little bit a different angle from it. Unfortunately, I also know quite a lot of unsuccessful implementation or incomplete implementation of that. So many clients struggle how to build the right strategy. They are testing, they are learning, they are trying new features, I think that usage of open banking is very promising, and information from PSD2 from the bank accounts used in collections is very efficient. Sometimes there is a problem with customer consent, and information is coming from that, but I think the insights from open banking are really promising, and I encourage everyone to go deeper and make a deep dive on that. Also test, I would say, different tools and different solutions from different vendors, not only the self-made solutions, because the differences are in details, but sometimes it makes a difference.
Thanks a lot, Bartek. And I think that was the final question we've received from the audience. Many thanks for sharing those questions. I will just do a little bit of product placement for the sessions coming up over the next couple of weeks. And what we have next week is the more advanced deep dive into strategy management part 2. And we have a client joining us for that session. So it'll not only be experienced consultants talking, we have a Danish consumer finance bank coming in to explain how they use our solution, both in terms of setting the strategies, but also how they use it for simulation of strategies. The following week, we have the roadmap, your knowledge, your level up your knowledge, the PowerCurve roadmap activity, where we're going to present what the roadmap of PowerCurve is moving forward, with a high focus on the cloud direction we're moving towards. Last but not least, the 27th of October, we have more around AI and machine learning capabilities. That's it from our side. I would like to say thank you for joining this session. I hope you found it useful, and hope to see you next week, same time, same place, and stay safe. And until next time. Bye.
Thank you. Stay safe. Thank you very much.